So hi guys, today we're going to be discussing accounting for accumulated profits or losses or retained earnings. So accumulated profits, or also known as retained earnings, represent the accumulated earnings of the corporation since the date of its incorporation. A portion of it can be free, while a portion may also be appropriated. Having an appropriation simply means that that portion is already restricted and cannot be distributed as dividends. Retained earnings is usually credited for net income and reversals of appropriations, and debited for net loss, appropriations, and dividend declarations. It has a normal credit balance, meaning these credits would increase its balance while debits here would decrease its balance. Unlike sole proprietorships and partnerships, a corporation's net income is close to the retained earnings account as shown by this journal entry. So you debit income summary and credit retained earnings. A corporation which has continually sustained losses could have a negative or debit retained earnings balance. In this case, it is said to have an accumulated deficit. Earlier, I mentioned that a portion of retained earnings can be appropriated or restricted. The need for such appropriation can be required by one of the following. So first is when it is required by law. This is the case when a company acquires its own shares or acquires treasury shares. The entry for such would be to debit retained earnings and credit appropriation for treasury shares. The amount to be appropriated should be equal to the total cost of your treasury shares. Second is when it is required by contract, such as when there is a need to retain within the business assets needed for the retirement of bonds. To make this appropriation, simply debit retained earnings and credit appropriation for bond sinking fund. Third is when required by the board of directors, such as when there is a plan for plant expansion. To record this, simply debit retained earnings and credit appropriation for plant expansion. So as you can see that there are various purposes for appropriations, but the most basic entry would be to debit retained earnings and credit appropriation for whatever purpose you have. When the appropriation is no longer needed, such as when treasury shares are sold, it would be proper to reverse the appropriation. To do this, simply reverse all the entries we have discussed above. So in other words, for the first one, the reversal entry would be a debit to appropriation for treasury shares and a credit to retained earnings. For the second one, we have to debit appropriation for bond sinking fund and credit retained earnings. And to reverse the third one, we have to debit appropriation for plant expansion and credit retained earnings. So now we move on to dividends. When a corporation earns income from its operations, it may distribute dividends as a return on the shareholders' investments. Formally defined, dividends would be the distribution of earnings by the corporation to its shareholders in proportion to the shares held by the respective owners. As I have mentioned earlier, dividends can only be paid out of the free or unappropriated portion of retained earnings. Unissued shares, subscribed no-par shares, and treasury shares do not receive dividends. Subscribed par value shares are entitled to dividends. So dividends can be paid either out of capital or out of earnings. Out of capital is the return of capital or investments, such as in the case of liquidating dividends. The more common type of dividends would be those out of earnings or returns on capital. Under this, we have four types, namely cash, property, scrip or liability, or share dividends. A cash dividend is a pro rata distribution of cash to stockholders. For a corporation to pay a cash dividend, it must have retained earnings, adequate cash, and declared dividends. A property dividend is a dividend payable in the form of non-cash assets. So this type of dividend produces retained earnings by the cost or carrying value of the property on the date of declaration. Property distributed normally takes the form of assets that can be easily divided or allocated among stockholders. So, for example, would be the stocks of other corporations which is owned by the company. A scrip or liability dividend is a deferred cash dividend. So, this consists of a written promise to pay certain amounts at a future date. A scrip dividend can be declared when the corporation has sufficient retained earnings balance but not sufficient funds at the time for a cash dividend. So the payment normally includes the principal amount and an interest at a specified rate. A stock dividend or a share dividend, also known as a bonus issue, is a distribution of dividends in the form of the corporation's own stock. Note that for stock dividends, the company is issuing its own shares, whereas in property dividends, the company would be issuing the shares of another corporation which it has ownership of. So cash dividends can be expressed either as a percentage of a par or as a certain peso amount per share. The first is applicable to par value shares, while the second is applicable to no par value shares. So important dates to remember are the following. First is the declaration date, or the date on which the board of directors formally declares a cash dividend and the liability is recorded. Record date is the date that marks the time when ownership of outstanding shares is determined from the stockholders' records maintained by the corporation. The last would be the date of distribution or the date of payment, which is the date the dividend checks are mailed to the stockholders and the payment of the dividend is recorded. So, on the date of that declaration, we have to make a debit to retained earnings and a credit to cash dividends payable to recognize the liability. On the date of record, the corporation makes no entry. And on the date of distribution, we debit cash dividends payable and credit cash. On March 1, 2013, the Board of Directors declared a 10% cash dividend payable on April 30, 2013 to shareholders on record as of April 15, 2013. So assuming that the company has 10,000 outstanding shares with 50 pesos par value, we compute for the total cash dividends by multiplying 10%, which is the rate of cash dividend, by 50 pesos par value by 10,000 outstanding shares. So that's a total of 50,000 pesos. So we also identify the different dates here. So this would be your date of declaration. April 30 would be your date of distribution or payment, and April 15, 2013 would be your date of record. So the entries for that would be here. So March 1, your date of declaration would require debit to retained earnings and a credit to cash dividends payable for 50,000 pesos each. And then no record is to be made on April 15, which is your date of record. And on April 30, your date of distribution, you need to debit cash dividends payable and credit cash for 50,000 pesos. Our next example is for a cash dividend presented as a peso amount per share. So on March 1, 2013, the Board of Directors declared a 10 peso cash dividend per share payable on April 30, 2013 to shareholders on record as of April 15, 2013. So assuming you have 6,000 shares, we compute for the total cash dividends payable by multiplying 6,000 by your cash dividend, which is 10 pesos each. So that's a total of 60,000 pesos. Again, March 1 is your date of declaration. April 30 would be your date of payment, and date of record would be April 15, 2013. Now, the entries you need would be the same as earlier, but the difference would just be with the amounts here. So this is your date of declaration. So a debit to retained earnings and a credit to cash dividends payable. Again, no entry for the date of record, and a debit to cash dividends payable and a credit to cash for the date of payment. Now, cash dividends can also be provided when a corporation has two classes of shares. But before we learn how to compute for the cash dividends given such scenarios, we have to first distinguish the different kinds of preference shares. We have four basic types, which would be your non-cumulative preference shares, cumulative, non-participating, and your participating shares. Non-cumulative preference shares are those that are only entitled to the dividends for the current year only. So this means that if the corporation does not declare a dividend in the previous years, the preference shares would no longer be entitled to receiving them. Now we have cumulative preference shares, which are entitled to dividends in arrears. So this means that if a company does not declare dividends for the previous years, the preference shares would be entitled to them once the company finally declares dividends. So for example, if company A does not declare dividends for years 1 and 2 but declares a dividend on year 3, a cumulative preference share would be entitled to 3 years worth of dividends. And then we have a non-participating preference share, which has a fixed rate of return. So its dividends would be limited to the rate attached to the preference share. Next, we have a participating preference shares. So these preference shares receive additional shares in net income in addition to the rate of return attached to it. But usually, preference shares have a combination of the various characteristics here. So it can be non-cumulative non-participating, non-cumulative participating, or cumulative non-participating, or cumulative participating. So let's have a sample problem to understand the computational side. So here, given the following, so you have 7% preference shares, so that's 2,000 issued shares with a 10 peso par value, and then you have 4,000 ordinary shares with a 10 peso par value, and then retained earnings of 80,000. And assuming that the board of directors declared 24,000 pesos worth of cash dividends this year, but no dividends were declared last year. So again, there are four variations, the combinations I discussed earlier. So that's non-cumulative, non-participating, cumulative, non-participating, non-cumulative participating, and cumulative participating. So the first scenario is when the preference shares are non-cumulative and non-participating. So first thing you need to do is make a separate column for the preference and ordinary shares. So first you need to provide for the preference share dividends, which you compute by multiplying the rate by the par value and by the number of issued shares. Issued and outstanding shares. So since the preference shares are non-cumulative, you only provide for the dividends in the current year. So you multiply it by 1 year. So you get 1,400. And then since it's non-participating, this means that all the remainder of the 24,000 cash dividends would go to ordinary shareholders. So you simply need to deduct the 1,400 dividends from the 24,000 cash dividends declared to get the dividends for the ordinary shareholders. So your total dividends would be 1,400 for preference shareholders and 22,600 for ordinary shareholders. And then you divide it by the number of outstanding shares. So it's 2,000 for preference shares and 4,000 for ordinary shares, and you get a 70 cents dividend per share for preference shareholders and 5.65 pesos per share for ordinary shareholders. The next scenario is when your preference shares are cumulative and non-participating. So first, again, you need to provide for the dividends of the preference shares. So since it's cumulative, it's entitled to dividends in arrears. And as the problem states, dividends last year was not declared. So this means that there's 1 year in arrear and you need to add the current year. So that's 2 years multiplied by 7%, multiplied by 10 peso par value, and multiplied by 2,000 outstanding shares. So you get 2,800 for preference shares, and then since it's non-participating, ordinary shares would get the remainder of the 24,000, so you get 21,200. Again, you divide it by the number of outstanding shares to get 1.4 for preference shares and 5.3 for ordinary shares. The third scenario would be when your preference shares are non-cumulative and participating. So again, you need to provide a 1 year worth of dividends for your preference shares. So that's 1,400 as we have computed earlier since it's non-cumulative. And then since the preference shares are participating, we need to provide 1 year's worth of dividends to ordinary shareholders using the same rate of your preference shares, which is 7%. But remember that we only provide for 1 year's worth. So that's 4,000 issued and outstanding shares multiplied by 10 pesos par value, multiplied by 7%, multiplied by 1 year, we get 2,800. So that amounts to 4,200, meaning we have a balance for participation of 19,800 here. So this amount should be split among preference shares and ordinary shares. So we see that the preference shares is still participating in the net income that was supposed to be for ordinary shares. It would be divided between preference shares and ordinary shares according to the value, which is the number of shares multiplied by the par value. So for preference shares, we have 20,000 over 60,000. And for ordinary shares, we have 4,000 times 10,000, 40,000 over 60,000 here. So these are the amounts we get. So the total dividends for preference shares would be 8,000 and 16,000 for ordinary shares. Again, we divide it by the number of outstanding shares, which is 2,000 for preference shares and 4,000 for ordinary shares. We get dividends per share of 4 pesos for preference shares and again 4 pesos for ordinary shares. The last combination is when preference shares are cumulative and participating at the same time. So we follow the same steps as that of scenario 3, but first we provide for the preference share dividends, but since it's cumulative, you have to provide for 2 years worth of dividends, which is last year and this year. Again, that's 2,800. And then since it's participating, we need to provide a 1 year's worth of dividends for the ordinary shareholders using the rate of the preference shares. So that's 2,800. And then the balance would now be divided between preference shares and ordinary shares using their value according to their value. So that's 2 over 6 and 4 over 6 for ordinary shares. So the total now would be 8,933.33 for preference shares and 15,066.67 for ordinary shareholders. Dividing the totals by the number of outstanding shares, again, we get the dividend per share. So that's 4.47 for preference shares and 3.77 for ordinary shares. So now we move on to the preparation of the statements of shareholders' equity. So I'm gonna give you a sample problem to understand the process. So first is given these balances at the beginning of 2013. And then, so that's preference shares capital, and then ordinary shares capital, and then share premium for ordinary shares, share premium for preference shares, retained earnings, free and appropriated, and then treasury shares worth 250,000. And so for 2013, these transactions occurred. So assuming A purchased 500 preference shares for 120 pesos each, so that's above par since preference shares have a 100 peso par value, and ordinary shares for 60 pesos each, again above par since ordinary shares have a 50 peso par value. And then B subscribed to 50 preference shares for 70,000, 20% down payment. And then C subscribed to 100 ordinary shares for 50 pesos each, so that's at par, and then 10% down payment. And then Corporation Y purchased 3,000 of its own shares for 30 pesos each, so that's treasury shares. And then net income for the year amounts to 500,000 pesos. So the first thing you need to do for beginners would be to record the transactions. So the first transaction would be recorded by debiting cash for 60,000, which we get by multiplying 120 by 500, and then credit preference share capital for the number of preference shares at par, so that's 500 times 100, so that's 50,000, and credit share premium preference for the amount in excess of the par, which is 10,000. And then we also have to debit cash for 60,000 for the ordinary shares, and then credit ordinary share capital for 50,000, which we get by multiplying 1,000 by 50 pesos par, and then crediting the excess to share premium ordinary shares. So the next transaction is when B subscribed to 50 preference shares for 70,000 pesos. So 50 preference shares at par would only amount to 5,000 pesos. So this means that 2,000 would go to your share premium, as seen here. The cash received would be equal to 20% of 7,000 since it's only a down payment, so that's 1,400, and the remainder would be debited to subscriptions receivable preference shares, so that's 5,600. The third transaction is again a subscription, but now it's to ordinary shares. So still you debit cash, debit subscriptions receivable, and credit subscribe ordinary share capital. We no longer have a share premium account since it's subscribed at par. 10% of 5,000, which is 50 times 100, is 500. So the remaining balance goes to subscriptions receivable, and we credit the whole amount of 5,000 for subscribed ordinary share capital. So the fourth transaction is a purchase of its own shares. So that's a debit to treasury stock and a credit to cash for 3,000 times 30, which is 90,000. And then net income would be recorded by debiting income summary and crediting retained earnings for 500,000. So to make a statement of changes in equity, we have to first label the headings, which so that's the name of the corporation, and then the type of statement being prepared, which is the statement of changes in equity, and the date, which is for the year ended December 31, 2013. And now we have to label the headings for every column. So first we have the share capital for preference shares, and then we have ordinary share capital, and then we have share premium, and then retained earnings for free and appropriated portions, and then treasury shares, and then the total. The first thing you need to record would be your balances at January 1, which is this one, the one given earlier. So you just need to copy it. So that's 500,000 for preference shares, and then 1 million for ordinary shares, 550 plus 350, that's your total share premium, amounting to 900,000, So you record that in your share premium column. So now we have to record your retained earnings. So 350 in the free column, and then 250,000 for appropriated. And then 250,000 would go to your treasury shares. And remember that any addition to treasury shares would be a negative sign since it reduces your shareholders' equity. After recording the initial balances, we now have to record all those that we made journal entries for. So the first one would be this one. So that means your preference share capital has a 50,000 additional, so that's 50,000 here. And then share premium would be 10,000. So you record that in the share premium column. So a total of 60,000 pesos. And then we also have a subscription for preference shares. So that's 5,000. And then 2,000 share premium for a total of 7,000 pesos. And then we also have to record the subscriptions receivable for preference shares. That's 5,600. And like treasury shares, receivables are shown as a negative number since these reduce your shareholders' equity. So that's negative 5,600. Again, we do the same for ordinary shares. So we have it here. You issued ordinary shares. How many ordinary shares? 50 pesos par. So that's 50,000. You just copy the amount, and 10,000 share premium. So that's 60,000. And now we also have a subscription to your ordinary shares of 5,000. So you record that here in the ordinary shares column. And then since there's no share premium, you leave the column for share premium blank for a total of 5,000 here. And then you also have to record the subscriptions receivable of 4,500. And again, it's a negative sign since it's a debit here and it reduces your equity. So that's negative 4,500. And now we move on to recording your net income. So since it's a credit to retained earnings, we record it at the retained earnings column under free since it's not appropriated. So there, 500,000. And then we also have to record the appropriation for treasury shares. Since we acquired 90,000, we have to appropriate a portion of retained earnings for that cost. So we reduce the free retained earnings by 90,000 and add 90,000 to the appropriated side. The last would be to record your purchase of treasury shares. So that's negative 90,000 since it's a debit here, and that would mean a reduction in your equity. So there, negative 90,000. So what you need to do now is simply to get the total of all the columns and all the rows, and then you'd get a total equity of 4,281,900. And there you have it, your very own statement of changes in shareholders' equity. That's all for today, guys.